The market's relationship with technology is fundamentally built on trust. But what happens when that trust is challenged by a viral video of a Tesla driving straight into a cartoon-style wall? Today, we're examining how recent demonstrations of Tesla's self-driving limitations reveal deeper patterns in market behavior, technological trust, and what it means for investors watching this space. Let's establish some context. Former NASA engineer Mark Rober recently put Tesla's vision-based driver assistance systems to the test against LiDAR technology used by competitors. The results were both comedic and concerning. A Tesla on Autopilot drove directly into a wall painted with an image of a road, literally recreating a Wile E. Coyote cartoon scenario. While this might seem like simple entertainment, it reveals fundamental technological limitations that have serious market implications. This test highlights a critical pattern we've observed repeatedly in technology markets: the tension between technological reality and market narratives. Tesla has built much of its $600+ billion market valuation on promises of autonomous driving capability, with Elon Musk repeatedly claiming full self-driving is just around the corner for nearly a decade. Yet the technological reality appears significantly more complex. From a sociological perspective, what's fascinating is how markets form collective beliefs around technology that haven't yet been fully realized. Tesla's stock price doesn't just reflect current performance. It incorporates a shared narrative about future capabilities, particularly around self-driving technology and robotaxis. This creates what sociologists call a performance expectation gap, where the difference between promised capabilities and actual functionality creates market vulnerability. Let's examine the technical debate at the core of this issue. Tesla has committed to a vision-only approach for its autonomous systems, relying exclusively on cameras rather than incorporating LiDAR or radar technology used by competitors. This decision was driven partly by cost considerations. Cameras are significantly cheaper than LiDAR systems, but also by Musk's philosophical belief that since humans can drive with vision alone, machines should be able to as well. However, this approach has significant limitations. Vision-only systems struggle with depth perception, are vulnerable to visual spoofing as demonstrated in Rober's test, and perform poorly in adverse weather conditions like fog or heavy rain. These limitations create real-world safety concerns that could eventually translate to regulatory challenges and market headwinds. What's particularly interesting from a market forecasting perspective is that Tesla recently received a ride-hail permit in California, advancing its robotaxi ambitions despite these technological challenges. This creates a fascinating market tension. Tesla is simultaneously facing growing evidence of technological limitations while making regulatory progress towards services that would require those limitations to be overcome. This pattern of advancing plans despite technological limitations reflects a broader sociological phenomenon in technology markets: aspiration-driven valuation. Markets often value technology companies based not on current capabilities, but on collective beliefs about future potential. This creates a precarious situation where market valuations can remain disconnected from technological reality until a tipping point is reached. Let's consider the competitive landscape. While Tesla struggles with basic obstacle detection using vision-only systems, companies like Waymo have accumulated over 20 million miles of real-world testing using more comprehensive sensor suites that include LiDAR. The market is currently valuing Tesla's autonomous driving potential more highly than these competitors, creating what might be a significant mispricing of technological capabilities. There's another concerning pattern that emerged from these tests. Reports indicate that Tesla's autopilot system may disengage moments before an unavoidable collision, potentially allowing the company to claim the system wasn't active during crashes. This raises serious questions about data transparency and regulatory compliance that could have significant market implications if investigated by authorities. Looking at historical parallels, we can see similar patterns of market correction when technological promises meet reality. Companies like Theranos maintained high valuations until technological limitations became impossible to ignore. The question for investors is whether Tesla's self-driving limitations represent a fundamental threat to its valuation or merely a speed bump on the path to eventual technological breakthroughs. Tesla's market story is further complicated by its diversification beyond vehicles. The company is developing humanoid robots called Optimus that Musk claims will eventually constitute the overwhelming value of Tesla. Yet these robots face similar challenges in computer vision and environmental interaction as Tesla's self-driving systems, potentially compounding technological risk across product lines. From a forecasting perspective, we can identify several potential market scenarios. In one, Tesla successfully navigates these technological challenges, perhaps by eventually incorporating additional sensors or making breakthrough improvements in vision-based AI, maintaining its market premium. In another, competitors with more robust sensor approaches gain market advantage, forcing a significant revaluation of Tesla's autonomous driving prospects. The most likely outcome lies somewhere in between, a gradual market recognition that full self-driving capabilities will take significantly longer to develop than Tesla has promised, leading to a more realistic valuation that acknowledges both the company's innovations and limitations. This would represent a market correction rather than a collapse, bringing expectations more in line with technological reality. What are the broader implications for investors? First, technological demonstrations like Rover's test matter because they make abstract limitations tangible to mainstream investors. Second, regulatory progress and technological capability need to advance in tandem. Permits alone don't solve fundamental technical challenges. And third, market narratives can sustain valuation premiums for extended periods, but eventually must reconcile with technological reality. It's worth noting that this analysis isn't about whether autonomous vehicles are possible. They likely are, given enough time and technological development. The question is whether Tesla's specific approach and timeline promises align with market expectations and valuations. In conclusion, the market sociology around Tesla reveals a fascinating case study in how technological trust, market narratives, and actual capabilities interact to create valuation dynamics. While a cartoon-inspired test might seem trivial, it represents a visible manifestation of deeper technological challenges that markets will eventually need to price in. For investors, understanding these patterns provides valuable context for navigating the complex relationship between technological promises and market realities.